Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 10th of July. I'm Daniel Lam, your host for the podcast. We will conclude our podcast on semiconductors with the implications of tariffs, which again has become the trending topic over the last few days. Now, recent analysis by the Information Technology and Innovation Foundation suggests that the blanket 25% tariff on semiconductor imports could lower US GDP growth by 0.2% in the first year, and the effects being felt even after a decade. And this is because tariffs raise production costs in many downstream industries that are of strategic importance to the Trump administration. For example, automobiles or servers that underpin hyperscale data centers. Tariffs would also add to the cost burden of stacking, i.e. the imposition of multiple tariffs, given sectorial tariffs are already in place. So for example, steel and aluminum are important for semiconductor manufacturing equipment. Now secondly, retaliation against tariffs can represent a net loss for supply chain de-risking. Many upstream components in the semiconductor production are impossible to onshore for geological reasons, and many minerals that are crucial for production are mostly sourced from China. Tariff retaliation can also restrict US access to legacy chips, which are needed for a vast array of consumer goods and are also used in the same hardware as advanced chips. So in a scenario of broad retaliation between the US and its trading partners, US semiconductor manufacturers risk being competitive only in the domestic market and losing access to faster growing markets such as Asia. So is there an alternative to tariffs which can also manage disruption on semiconductor supply chain? Well, the US can try to form a supply chain security agreement or semiconductor-focused plurilateral groups built around common objectives with like-minded and trusting trading partners. However, Trump's skepticism of the principles of multilateralism and international cooperation makes these recommendations relatively unrealistic. So overall, the demand for semiconductor is going to stay strong due to the bullish trend in AI. At the same time, supply chain disruption is not avoidable, which leads to ongoing volatility in semiconductor-related stocks. Now recently, we closed our opportunistically bullish idea on US semiconductors, and that was because of the recent rally rather than questioning the long-term bullish trend. There will be interesting entry points ahead as investors can consider adding exposure in stages if the S&P 500 index pulls back to the 5,900 and to the 5,700 levels. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.